The prevailing wisdom in the market is that companies like Microsoft, Alphabet, and Amazon are sitting on mountains of cash so vast they can buy entire nations. And for years, they were right. Cash was king, and big tech wore the crown. But in March 2026, something fundamental changed. While they may appear cash-rich, they are now engaged in a quiet, relentless sprint to borrow unprecedented amounts of money. We are witnessing the beginning of what could become a $1.2 trillion debt bubble, fueled entirely by the pursuit of artificial intelligence. Welcome back to the CEO of Finance. Today, we peel back the layers of corporate balance sheets to uncover why the biggest companies on Earth are secretly borrowing billions, and how this US and European-funded experiment is reshaping the global economy. To understand what is happening, we first need to address the common misconception about how these companies operate. When a company like Amazon generates tens of billions in free cash flow, many assume that money is immediately available to be spent on new projects. But large parts of that cash are immediately plowed back into maintaining their massive existing empires, the warehouses, the fiber optic cables, and the research for next year's products. But AI is a different animal. This isn't just about building another software product. This is about rewriting the entire computational infrastructure of the planet. And doing so requires capital on a scale we have never seen before. In March 2026, Amazon made a move that shocked many analysts. They announced a massive $37 billion corporate bond offering. It wasn't because they were broke. It was because the cost of building the data centers and buying the specialized AI chips needed to compete in the next phase of the digital revolution is simply too massive to fund with cash flow alone. The demand from US and European investors for this debt was overwhelming, reaching $126 billion. But this brings us to a crucial question. Why are they borrowing now rather than spending their own cash? To understand the why, we have to look at how global finance works, especially across the Atlantic. There are three main reasons for this borrowing spree. First, the cost of capital. Even with fluctuating interest rates, big tech companies with their AA credit ratings can borrow money at rates far lower than almost anyone else in the world. They calculate that the return they will get on these AI investments will be significantly higher than the relatively low interest they pay on the debt. Second, the operational treadmill. Free cash flow isn't stable. Using it entirely for AI would leave them vulnerable if their core businesses like advertising or retail experienced a temporary downturn. By issuing debt, selling bonds, they secure long-term, fixed-cost capital that doesn't threaten their daily operations. And third, the strategic currency exposure. This is a truly transatlantic strategy. These companies are issuing debt in both US dollars and euros. They match the currency they borrow with the revenue they generate in that region, reducing currency risk and tapping into the deep pools of institutional capital in both the US and the European Union. Now, we must confront the truly explosive part of this story. This isn't just Amazon, and it's not just one bond issuance. This is a systemic shift in corporate finance that affects the global economy. The Organization for Economic Cooperation and Development is now forecasting that the top 9 major players in AI infrastructure will issue a cumulative total of $1.2 trillion in corporate bonds between now and 2030, just to fund the capital expenditures required for the AI boom. We're talking about companies like Microsoft, Alphabet, Meta, Oracle, and the key chip suppliers. Every single one of them is on a borrowing sprint, leveraging their massive market caps to secure funds before competitors can secure the necessary infrastructure. This debt is being absorbed by pension funds, insurance companies, and everyday investors across Europe and the United States. Your retirement account, whether in New York, London, or Frankfurt, is likely a lender to this $1.2 trillion experiment. When numbers this large are involved, we have to talk about the risks. The $1.2 trillion question isn't if they can borrow the money, it's what happens next. The assumption underpinning this entire mountain of debt is that AI will generate colossal returns. But as of 2026, the gap between what companies are spending on AI infrastructure and what they are actually earning from AI products is still significant. If the anticipated revenue from generative AI, autonomous systems, and advanced computation doesn't materialize fast enough to service this debt, these companies will face difficult choices. They may be highly profitable, but $1.2 trillion in debt is not easily serviced if the anticipated growth slows. While big tech itself is unlikely to go bankrupt, a severe AI disappointment could lead to a massive correction in the technology sector, ripple through the stock and bond markets on both sides of the Atlantic, and potentially create systemic risk for the wider economy, given how heavily both markets are now intertwined with the tech giants. We are in essence financing a speculative technological revolution. If it works, it rewrites history. If it doesn't, it could become the most expensive asset bubble in modern memory. What we are seeing in 2026 is a monumental shift. The cash-rich technology sector is transforming itself into one of the largest debtors on the planet. This $1.2 trillion race to build the AI infrastructure of the future is funded by American and European capital based on a projection of future utility that has yet to be fully proven at scale. For you as an investor, this means one crucial thing. Look at your exposure. Whether you own individual tech stocks or an ETF, you are a participant in this debt-fueled experiment. The advice has always been to diversify, but in 2026, understanding exactly what you are diversified into and the massive debt underpinning the tech narrative is more critical than ever. The CEO of finance will be watching this $1.2 trillion story develop, tracking the bond issuances, the earnings reports, and the structural shifts in the transatlantic economy. If you found this analysis valuable, please like the video and subscribe to the channel. How do you see this AI debt bubble playing out? Is big tech right, or are we on the verge of a massive correction? Let me know your thoughts in the comments below. This is the CEO of Finance. Thanks for watching.